Hello, everybody. This is Alan Ellman, the blue collar investor. In the middle of 2022, BCI launched a new product, the BCI Trade Management Calculator. After a year and a half of development and beta testing, this new spreadsheet was launched, and what it accomplishes is it allows us to enter our covered call writing and cash secured put trades, get initial calculations for both each trade and the total portfolio. Then it gives us over 20 exit strategy choices between the two strategies and allows us to calculate final trade results for both each trade and for the total portfolios. As far as we know, this is the only spreadsheet of its kind anywhere in the world, and we're very proud of it. One of the most difficult concepts which the spreadsheet does allow us to do is how to enter multi-leg rolling out trades such that the calculation results will reflect accurately what our gains and or losses are. This particular video, titled Explanation of Rolling Out Trade Entries and Calculations using the BCI Trade Management Calculator, will detail exactly how to do it using this spreadsheet. So with that said, let's get started by defining what is rolling out. This is where we close out option contracts at a near month expiration date and open the same strike contract at a later date. Now, when we get to cash secured puts, we're actually going to roll out to a lower strike. So I want to show you the flexibility that this spreadsheet has when it comes to rolling out. Now, how do we enter these multi-leg trades such that it will reflect accurately what our results are? I mean, there's no point in doing calculations if they're exaggerated or underestimated. Now, the concepts I'm going to use in this video apply to both covered call writing and selling cash secured puts. And I'm going to be using a hypothetical covered call writing trade and a real life selling cash secured put trade that was provided to me by one of our BCI members that has a lot of interesting aspects to it, and I thought it would make an interesting aspect as well to this video. So it applies to rolling out, and these concepts will also apply to rolling out and up, and in the case of cash secured puts, rolling out and down. So let's start off with our covered call writing hypothetical trade. And after I give you this information from this slide, we'll move right to the spreadsheet, show you how to enter and calculate these results, and then we'll come back to the PowerPoint to do the same thing for cash secured puts. Okay, here we go. Covered call writing hypothetical. 321.22, 100 shares of BCI purchased at $48. So what's our cost basis? $4,800 for 100 shares. Then we immediately sell to open the 4/15/2022 $50 out of the money call at $1.50. So it's a little bit under 1 month expiration. So the total contract call sale will generate $150. Now on expiration Friday, 4/15/2022, BCI is trading at $52, leaving the 50 strike in the money, meaning that if we don't buy back that 50 call, our shares will be sold the Saturday after expiration Friday. So instead, the decision is made to roll the option, buy back the near month and sell the same strike for the next month or for a later expiration. In this particular case, buy to close the 4/15/50 call at $2.10, and that makes sense. Of that $2.10, $2 is intrinsic value. The amount that the 50 strike is lower than current market value, plus a small tiny bit of time value since it is expiration Friday, so we assign 10 cents to that. So $2.10 is a reasonable amount to buy to close that 4/15/50 call. Then we immediately sell to open the next month, the 5/20/2022 expiration, same strike 50 call at $3.75, thereby rolling out. So what is the net credit for that rolling out process? $3.75 credit The buy to close was 210 debit. That means a net credit of $1.65. Question is, how do we enter and calculate this data? So now what I'm going to do is we're going to go to a screenshot of the BCI Trade Management Calculator. The top of the spreadsheet, as you see here, is dedicated to covered call writing. The bottom part, which you'll see shortly, is dedicated to cash secured puts. Here we go. So we enter into the blue cells on the left, the initial trade entries. BCI trading at $48 on 3/21. We're going to sell the 50 strike with the 4/15 expiration at $1.50, 100 shares. So that information is gleaned from the option chain. Now, we slide over, we use this bar at the bottom to slide over to the second section of the spreadsheet, which gives us the following data. This is not data that we enter, this is data calculated from the information we just submitted in the blue cells on the left. And the spreadsheet tells us that we have a 26-day trade if taken to contract expiration. $1.50 per share is the time value profit in dollar amount. We have the possibility of another $2 if BCI moves from 48 up to or beyond that 50 strike. The break-even price point is $46.50. 48 we paid for the stock. $1.50 was the premium. Therefore, the break-even is $46.50. And then it will give us our actual percentage return on our option, an initial time value return. Doesn't mean we're going to get this at the end, but that's our starting point. 3.13% for a 26-day trade, and that would annualize out to 43.87%, with an additional possibility of 4.17% if BCI moves up from 48 to 50. Once again, per contract, that's 150 in cash, a possibility of another 200 in cash on the stock side if it moves up to that 50 strike on an investment of $4,800. The spreadsheet will also give us our exit strategy buy to close price point thresholds, which is beyond the scope of this video. Let's scroll over now to section 3 of the spreadsheet, and this is where we have our exit strategy opportunities. So here you see on the top row, we're going to roll out. Well, whatever the exit strategy is, you could just click on that drop down, and this gives you all your exit strategy opportunities. So in this particular case, we're selecting rolling out. The date of that rollout was 4/15. The only other entry that we have to make when we're rolling out is the value of the stock at the time of the rollout. And in this particular case, it's 50. Even though it's trading at 52, because of our contractual obligation to sell at 50, we have to enter 50 as the actual value. So once we enter that, the spreadsheet will then show us what our final returns are prior to rolling that option. So you see here that it's $1.50 or $150, 3.13%. We did get that additional $2 because the shares did go up from 48 to the 50 strike and actually beyond, but we're only crediting it $2 to the 50 strike because of our contract obligation. That's another 4.17%. So our total combined trade results for the near month is 7.29%. Okay, now let's slide back to the first section, and we're going to enter the next trade for the next cycle over here. Now, let me stop for a second and tell you how I actually do it. I like to keep all my spreadsheets based on the expiration date. So what I do is, before I would enter this 4/15 trade, I would go to File on the top left, Save As, and then and you could save it on this PC, wherever you want, and I would save it as TMC 4/15/22. So all the trades for that 4/15 expiration would be on that same spreadsheet for both covered calls and selling cash secured puts. That's how I like to do it. Now, you may want to put different expiration dates on the same spreadsheet. That's fine. But I like to collate it that way, print it out, and put it in a binder for each particular contract cycle. Then I can go back and study it. I have everything archived accurately. However, for this video, I'm going to put them both on the same spreadsheet so you could see them on one screenshot. Now, remember, we closed out the original trade based on the original calculations plus that additional upside value. Now we go in and we enter the next trade for the next cycle. Once again, BCI, the entry date is 4/15. That was expiration Friday for the last contract. The next expiration date is May 20th, 22. And the price of the stock, the value of the stock is not 52, but 50. That, folks, is what our shares were worth in reality when we entered that trade. And the strike, since we rolled out to the same strike, is still 50. And the premium is $1.65. Remember, it cost us $2.10 to close the original 50 strike, and we generated $3.75 when we sold the new 50 in the money strike. That resulted in a net time value credit of $1.65 for the same 100 shares. Let's use the bar to scroll over to the initial returns. And remember, on the second row now, the spreadsheet tells us that now we're in a 36-day trade. The premium was $1.65. The break-even price point is $48.35. And remember, the shares are actually, in reality, worth 52 at the time of the roll. So pretty decent protection, although it's not reflected in the spreadsheet. I'll get to that in a second. But our actual time value return on this trade now is 3.3%. And based on a 36-day trade, that's an annualized return of 33.46%. Once again, the time value return in dollars is 165 per contract, and our cost basis is $5,000, 50 times 100. That's how much we're risking in the trade. And then, of course, we have our exit strategy price point thresholds. Let's scroll over now to the next section, which at this point in time, based on the information and data that I just gave you, we don't know if we're going to do any exit strategies. That's to be determined. We just rolled. We're at the point where we just rolled the option. So what are our results at this point in time? Our results are 3.3% for that next exit strategy cycle, expiration cycle. And I just made a note in the covered call trade management journal that there was in fact downside protection from 52 to 50. Now, some of you who already have the trade management calculator might be saying, wait a minute, I don't have this section on my spreadsheet. And the reason is because we just put it in. So everybody who will purchase this spreadsheet moving forward will get this trade journal. However, we didn't forget about everybody that purchased it already. We have your name and email on file, and we will be sending you the enhanced, updated version of the trade management calculator at no additional cost, which will include this section. So look for that in your email box very shortly from when I'm making this video. So that shows you the rolling out for covered call writing. Now, what I want to do is I want to go back to the PowerPoint, and we're going to move on now to selling cash secured puts. And you'll see that the concept is the same, although this example is a little bit trickier. And it was provided to me by Jeff, one of our BCI members. And we're going to be looking now at a real-life trade with Exxon Mobil, which trades on the New York Stock Exchange under the ticker symbol XOM. On 6/22, XOM was trading at 88.82, and the 6/24, it's only a couple of day expiration, 85 out of the money put, remember, out of the money for puts is lower than current market value, was sold at 36%. Well, some of you may be yawning and going, 36 cents, hardly worth it. Well, when you see the annualized returns, you're probably going to think differently. So the next day, what happens? XOM goes from 88.82 down to 84.39. Well, this was during a time period when energy prices were just volatile all over the map, as inflation was impacting our market and so on. So there was a lot of volatility. So yeah, it went from 88.82 down to 84.39. What happened? The 624.85 out of the money uh, put at the time of the trade, now in the money, was closed at 75 cents. You can see there was actually a debit. Initially sold at 36 and then closed at 75. So there was an actual debit. However, the trade was rolled out to the 7-1 a week later expiration. 84 puts, so a slightly lower strike, deeper out of the money, slightly out of the money in relationship to the current market value of 84.39. And that was sold at a credit of 224. So the trade was rolled out and down to a deeper out of the money put strike. Then the next day, boom, XOM went back up to 88.11, and the trade was closed by the close, that 7-1-84 put at 75 cents. So the trade was closed and exited, done, finished. Okay, now the rationale behind it is beyond the scope of this presentation. Many of you may agree with it, some of you may disagree with it. It really doesn't matter at this point in time. We're just looking to see how to do our entries when we roll these. So let's return to our BCI trade management calculator, and we're going to scroll down. Before I do that, let me just show you one thing. Go back up here. And I just want to show you that the spreadsheet will also give you total portfolio initial results and total portfolio final results. Okay, so that applies to both covered call writing and selling cash secured puts. So now we're scrolling down to the cash secured put section. Here we go, see cash secured puts. So this is in the lower half of the spreadsheet. And I want to show you how we enter the data for the cash secured puts trade. So we have XOM, again, you can enter the industry, the earnings report, ex-dividend date. For those of you familiar with the BCI methodology, you know why you might enter this data for diversification, cash allocation, avoiding earnings reports, and dividend date is the main reason for early exercise, again, beyond the scope of this video. So on 6/22, XOM was trading at 88.82. The 85 out of the money cash secured put was sold for 36 cents with an expiration of 6/24. So that's the information that we enter from the option chain. And now the second section over here shows the calculator will let us know, hey, folks, it's only a 3-day trade generating 36 cents or $36 per contract. How much cash will be required? Well, it's the strike price minus the premium times 100, and that's 84.64, which is also our break-even price point. And it tells us that that 3-day trade generated an initial time value return of 0.43%. But based on a 3-day trade, that annualizes out to 51.75%. So that 36-cent return is looking a little bit better now. Now, you can see here that if the price of Exxon Mobil drops below that strike price, then the shares will be purchased at a discount of 4.71% from when the trade was initially entered. So those are the two outcomes, either a return of 0.43%, 51% annualized, or buying the stock at a discount of 4.71%. And if exercised, that is the break-even price point. And once again, it shows the capital invested and the exit strategy price point thresholds. So let's now go over to section 3, which is the exit strategy opportunities. And you see here that we selected rolling out. once again, just like for the covered call writing, there are multiple exit strategies you could choose from, but we're going to use rolling out. And that was the trade adjustment date, you recall, was 6/23, the next day after the trade was entered. And all we have to do is enter the current price of the stock. Remember, we didn't buy the stock. The stock was just trading at 84.39 at the time. So for the near month, the trade ends. And what does it end at? The original initial time value return of 0.43% or $36 per contract. Same thing as covered call writing. Now, let's scroll all the way over to the left, and we see now that we're going to enter the next trade. When did we enter the trade? The next day on 6/23, and now this is for a 7/1 expiration, so a new expiration date. Again, if you want to have separate spreadsheets, just go to File, Save As, and you could save it as TMC based on the expiration date of each contract. That's up to you. Now, the price of the stock, if you recall, was 84.39, and we sold the slightly out of the money 84 put for $1.49. Now let's slide over and get our initial calculations. And the spreadsheet shows us now that we're involved in a 9-day trade if taken to contract expiration with a time value premium of $1.49. Okay, and that $1.49 comes from generating 224 on the second month, the second expiration, minus the 75-cent buy to close for the near expiration, and that netted $1.49. That's what we enter in the time value return. It's the net credit and debit, and that's $1.49. $149 per contract, and the cash required again is $82.51. And that results in a 9-day return of 1.81%, which annualizes out to 73.24%. So pretty nice return. Again, it's a volatile situation, and that's why the premiums are so juicy at this point in time. If the stock is, if the price moves below that 84 strike, the shares are purchased at a small discount of 2.23%. Remember, it was trading at 84.39 when that second 84 out of the money put was sold. And once again, if exercised, it's exercised at a break-even price point of 82.51, and that's the amount of our investment. Once again, you have your break-even, your exit strategy price points. Now, if you go over to the next section, if you recall, what did we do? Well, we closed the strike. Now, generally, we close only in the money strikes, so that's the only choice you have here. But as you'll see, we'll make a note of that in the journal section. So we closed the strike and exited. What date? Next day, 6/24. The expiration date was 7/1, and it was closed at the 75-cent debit. And the price of the stock, if you recall, had moved up to 88.11. Once again, the rationale for the trade is beyond the scope of this presentation. You may agree, you may disagree. That's unimportant here. I just want to show you how to enter these trades. Now let's go to section 4, which is the final results here. And you see now that the actual return dropped down to 0.9% because of that 75-cent debit, and the trade was exited. And that means our final return on the second trade was 0.90%. Remember, it was only a 2-day trade when it was closed down. So it annualizes out to a large amount. Plus, the cash then that was used to secure that put is now freed up, and we could use it to then sell another cash secured put. Now, if you notice, you could use that journal. This is now the cash secured put trade journal for the lower section of the spreadsheet. And I made notes for the first trade. It was only a 2-day trade. And I made a note here that we closed and added the money strike. And again, that also was a 2-day trade. Entered one day, closed the next. So we consider that a 2-day trade. So that's how we do it. So let me go back now to the PowerPoint. and move on to the next slide. Now, the information that I just gave you is found in the book. This is my 8th book that was published. Again, it came out in June of 2022, which is actually the month I'm making this video. And part of our BCI trade management package, the PDF version. So if those of you who have it, look in chapters 11, 12, 13, 24, and Appendix 4 to review how to enter all of these rolling out and up trades for both covered call writing and selling cash secured puts. For those of you who don't have the BCI trade management calculator and would like to get it, go to our website. You see on the bottom here, thebluecollarinvestor.com. Click where you see the red arrow, best discounted packages. Click on the one for the BCI trade management system. There's a video that will give you more details about it. And then you will be able to evaluate whether or not you'd like to get this spreadsheet. So, ladies and gentlemen, there you have it. I made this video because I felt the concepts, when first viewed, seem pretty complicated. But once you start doing this a couple of times, it will become very much second nature, and the spreadsheet has the capability to do this for us. So that ends this video explanation of rolling out trade entries and calculations using the BCI Trade Management Calculator. Ladies and gentlemen, I hope you enjoyed this video, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.